All right. In this chapter, we are going to talk about um, uh, flexible budgets and the intro to standard costing, dealing with the direct inputs, direct materials, and direct labor on this. And so let's start out by going to exercise 14 24 on page 611 of your book. Um, and this one, we have a new accountant for Cohen and Company. You've been asked to provide a succinct analysis of the financial performance just ended. Okay, so let's talk a little bit about when we did the master budget. We prepare a master budget for the future, right? And then we can compare our results to that master budget, but that only gives us one analysis, right? Did we sell more or less? Did we spend more or less? Did we make more or to make less? It's a one-way analysis. We're going to introduce the flexible budget in here, and what the flexible budget is it's we do it after the fact, and we do it with the idea that how much should it have cost us given the amount we actually either produced or sold, depending on what you're looking at. Um, and so you once you do that, now you can look at your actual versus your flexible, and you can decide, was the reason that we did we sell more? Did we sell more because we sold more units, or did we sell more because we priced it higher? Um, Also with expenses, did we um, were we under budget on expenses because we produced less, or were we under budget on expenses because the expenses cost less to produce? And so flexible budgets are very important, and then we will extend that on into the standard budget and break it down even standard costing and break it down even further. Okay, so um, we've got this data here, and it says our unit sold is actual was 40,000. The budget amount was 45,000. Sales was 380,000 versus 450. Variable cost was 210 versus 270, and fixed cost was 145, and the budget called for 135. All right, so uh, what would be the actual operating income for the period, showing calculations around your answer to the nearest dollar? So this is a very simple one because we have sales minus variable cost minus fixed cost. So we'll put the actual up here. And our actual sales was 380,000. And our the variable cost was 210,000. That gives us our contribution margin, right? Going back to that, is 170,000. Go ahead and put parentheses around that. Then we had our fixed cost was 145,000. And that gives us our operating income, which will be 25,000. Okay, that's what happened in the actual. Then our budget amount, I'm going to leave a space in between here. The budget amount, this is the master budget, was 45,000 units, and our sales was 450,000. Our budgeted variable costs were 270,000, and that gives us 180,000 as our budgeted contribution margin. Um, So then our fixed costs were supposed to be 135,000, giving us a budgeted operating income of 45,000. Okay, so now we can compare these results. Our sales were unfavorable by $70,000, right? Our variable costs were favorable by 60,000 because they were less, right? And then our contribution margin was unfavorable by 10. Our fixed costs were unfavorable by 10. And then our operating income was unfavorable by 20,000. Now, here's where we get the idea of the flexible budget. Okay, we sold only 40,000. What should the budget have been if we only sold 40,000, if we were expecting to sell 40,000? So 45,000 into 450,000 would be $10 per unit. And so if we only sold 40,000, our sales would have expected to have been, 400,000 on that. And then our variable costs also, that if we're expecting a variable cost of 270,000, and we are expecting to sell 45,000 units, that would be $6 per unit. So if we sold 40,000 units, our variable cost should have come in at 240,000. Okay. That means our contribution margin should have come in at 160,000. And our fixed costs don't change, right? That's why they're fixed. Should have come in at 135,000, meaning our operating income should come in at 25,000. So what we can do with this now is our sales were 20,000 unfavorable, right? We should have made 400,000, but we only made 380,000. This is known as the flexible budget variance. Here we came in at 30,000 favorable, right? Because we should have been at 240 for variable costs, but we were only at 210. So 30,000 variable there. And so our contribution margin is 10,000 favorable. Again, we should have come in at 160, but we actually came in at 170 because we were able to keep our variable costs down. And then, and later we'll break down this flexible budget variance when we get to standard costing. Then our fixed cost will be 10,000 unfavorable, leaving our operating income as neither favorable or unfavorable. That's the flexible budget variance. We can also do the volume variance. So we had 50,000 unfavorable due to volume, right? We just simply didn't sell we didn't sell 5,000 units that we were expecting to sell. And here we had 30,000, and that's favorable. And this is where you have to be a little bit careful. That favorable, we use the terms favorable and unfavorable, and you have to remember all this terminology came out of the 1920s and 30s. And it's been that way a long time, and you and I aren't going to change it. But yeah, it's favorable, but it's favorable for a bad reason, right? It's favorable because we didn't sell as many. So favorable and unfavorable shouldn't take on this pejorative connotation that we often give to it, at least not when we're doing this type of accounting. Here we have 160 versus 180, so we're 20,000 unfavorable, right? Because we're 20,000 less than the budget. The fixed costs between the flexible budget and the master budget will always be not applicable or zero because the fixed costs are fixed and they should be what they should be. And so that gives us a $20,000 unfavorable volume variance simply because we didn't sell as many as we should have. All right, so that's part 2 of this question. Or actually, that's the whole question. So that's exercise 14-24. Okay, let's go ahead and do 14-25 here also. Okay, we've got assume that in October of 2022, Schmidt Machinery manufactured and sold 950 units for $835 each. During this month, the company incurred 475 total variable costs and 180,000 total fixed costs. The budget data for the month are given in Exhibit 14-1. So let's flip back to Exhibit 14-1. All right. So it's right here on page 582 of your text. Here's the actual operating income. Here's the master budget. And let's see what they're going to ask us to come up with here. Okay, prepare the flexible budget for the production of 950 units. So here's the master budget information that we're using. They were selling 1,000. So I'm going to go ahead and write in the master budget. A little more space here. And our sales was for 1,000 units and $800,000. Our variable costs were supposed to be 450,000, giving us 350,000 contribution margin. Our fixed costs were supposed to be 150,000, leaving us with operating income of 200,000 on that. Okay, and so we're told that assume that in October of 2022, they manufactured and sold 950 units for $835 each. So our actual sales is 793,250. During this month, the company incurred 475,000 of total variable costs. And so that will give us 318,250 in contribution margin. Our fixed costs came in at 180,000. Giving us operating income of 138,250. Okay, so that's our actual. So then it asks us to prepare the flexible budget for the production and sale of 950 units. All right, so 1,000 units times 800 or $800,000 divided by 1,000 units would be $800 per unit. So we have 800, 900 times, was it 950 units sold. So that would be 760,000 is our budgeted sales, and then 450,000 in variable costs divided by 1,000 units would be $450 each times $950 would be 427,500, and so our contribution margin is 332,500. Our fixed cost, remember, will always be the master budget fixed cost of 150,000. Gives us operating income of 182,500. Okay. So now that is our flexible budget for that. Compute the sales volume variance in terms of operating income. So in terms of operating income, the sales volume variance would be 17,500 unfavorable there. And then part B says the sales volume variance in terms of contribution margin, indicate whether this variance was favorable or unfavorable. So here we would have 17,500. And what they're trying to drive home here is that the sales volume variance contribution margin will be the same as the operating income variance, because the fixed costs will be identical on that one. And then number 3A, the total flexible budget variance, indicate whether the variance was favorable or unfavorable. So we've got 182,500, 138,250 minus. So that'll be 44,250, and that will be unfavorable because we're less than the flexible budget. And then B, the total variable cost flexible budget variance. So here's the flexible cost. So we've got 475. And that will be 47,500, again, unfavorable because the actual was more than the budget. And it's, I think it's best just to deal with this on a common sense basis. What do you want? Better is favorable, right? You want your sales to be better. So if the actual is larger, it's favorable. If it's smaller, it's unfavorable. You want your expenses to be less. So if they're less than the budget, they're favorable, and if they're more than the budget, they're unfavorable. I think that's the best way to deal with that. is so the contribution margin variance is 14,250, and that is that's unfavorable because it's less than the budget. Our fixed cost is 30,000, unfavorable because this is an expense and it's more than, right? Um, and then finally, it asks for the selling price variance, so that'll be 33,250, and that is favorable. So that's the only favorable one that we have in this particular exercise. Okay, so that's 14-25. All right, the next one that we're going to deal with gets into standard costing, I believe. And it says, assume that Schmidt Machinery Company had the standard cost reflected in Exhibit 14-5. So let me go find Exhibit 14-5. All right, so that Exhibit 14-5 is on page 588. You can see here. So our direct materials, we have aluminum and PVC. 4 pounds at $25 a pound. PVC is 1 pound at $40 per pound. Direct labor is 5 hours at $40 per hour. And variable factory overhead, so it's going to be based on direct labor hours because it's 5 hours, the same as the direct labor. And it's going to be at $12 per hour. The fixed factory overhead, we apply it based on direct labor hours at $24 per hour. Okay, so these are our standard costs here, right? So now, all right, in a given month, the company used 3,450 pounds of aluminum to manufacture 920 units. The company paid $28.50 per pound during the month to purchase aluminum. At the beginning of the month, the company had 50 pounds of aluminum on hand. At the end of the month, the company had only 30 pounds of aluminum in its warehouse. Schmidt used 4,200 direct labor hours during the month at an average cost of $41.50 per hour. Okay, so compute the following variances for the month, all rounded to the nearest whole dollar. The purchase price variance for aluminum. Okay, so when we're doing standard costing, it is ordinary to calculate the purchase price variance at the time of purchase, because otherwise then you get into inventory problems. Are we going to do LIFO, FIFO, weighted average on these things? So by computing it at the time of purchase, the purchase price variance, we eliminate that problem. So this is 14-26. And so our purchase price, we are told the actual, and we purchased 3,450 pounds. That's the amount purchased, the quantity purchased times the price. Company paid $28.50. That's a zero there. $28.50. And so when I multiply that out, we get 98,325. Okay. Now, this middle column, if you go over here, you get the standard. And this middle column is kind of like the flexible budget idea. It's how much should we have spent given we bought this much. So we're going to take the standard over here would be the number of units produced times the standard per unit times the standard cost. So what we do on the purchase variance is we take the actual amount purchased, this 34.50 from here, and then we take this standard cost, which was in our thing here. The aluminum was $25 per pound. So we've got 34.50 times 25, we get 86,250. Now, honestly, this middle number means nothing by itself other than it's a way to get you to price variance and quantity variance. So we compare this one to this one. And we get 12,075, and that will be unfavorable, right? If you set it up the way I set it up, then what you have, you always want the one on the right to be, if the one on the right is bigger, then it is favorable. All right, so now we're going to take the information here and get a different middle column, right? Because this one we're calculating at the time of purchase, and this one we're calculating at the time of usage. So we're going back to here. At the beginning of the month, the company had 50 pounds of aluminum on hand, and at the end of the month, they only had 30 pounds of aluminum. So what that tells us is they used 20 more pounds than what they purchased, right? So their actual usage was 3470. Okay. Now this number is substituting for this number. This is at the time of purchase. This is at the time of usage. This number is substituting there. But now we use that $25. And for this one, we get we get 86,750. Okay, that's how much it should have cost us, given that we used that many pounds. But then we come in with this actual, or we have to use the standard again, and the standard is 4 pounds of aluminum at $25 a pound. So this 25 is the same as this 25, same as that 25. But then we need 4 pounds of aluminum, so that's $100, but that's per unit, right? We also need the amount produced, and the amount produced was 920 units. That comes from the narrative of the problem. So if we take 920 times 4 times 25, we get 92,000. And now we compare these two, right? And we get 5,250, and that will be favorable, okay? Um, because we used less than we were budgeted per unit. Now you also combine these two together. You can go across these, or you can go all the way across here to here. You're going to get the same answer. Treat the U and the F as if there were a plus and a minus sign. So we're going to end up with basically 12,075 and subtract off 5250, and we get 6825. This will be unfavorable. It takes the largest absolute value sign, unfavorable. And this is the total direct materials variance. This one, honestly, in this case, it's not real useful because this and this are two different numbers. Admittedly, it's not off by much. It's only 20 pounds of aluminum. So it's not off by much. But what you buy and what you actually use can be vastly different. You can imagine in the real world that there's a drop. And so we load up on this expecting that drop to be temporary, the drop in price. And so we load up on this and we're willing to pay the storage cost because we got it so cheap. Um, but anyway, the price variance is calculated at the time of purchase. The usage variance is calculated at the time of usage. And in this case, it's hard to justify that number there. Okay. Okay. And then they want us to calculate the direct labor variances. It's the exact same process of what we just did, except now we're going to substitute the direct labor. So if we look at our things again, our direct labor is 5 hours at $40 per hour. So one of the nice things about direct labor variances is you can't inventory labor. You can inventory the product of labor, but you can't inventory labor. And so we know that it's 5 hours times $40, and we know we made 920 units. So we know that this should have cost us $184,000 in labor in order to make 920 units. Again, we got that little high. Just kind of imagine here. Down here, we're going to use the 40, right? That's the standard cost. But then we use the actual hours used. And in the narrative, it says we used 4,200 direct labor hours. So 4,200 times $40 an hour is 168,000. So this is our direct labor usage variance or quantity variance. This is the amount of labor we used. And so this will be 16,000 favorable. Again, it holds. The one on the right is bigger than it is favorable. Then over here, we know we used an actual amount of 4,200. And the labor cost us $41.50 instead of 40. And so that will be 174,300. And what is that? 6,300. And that will be unfavorable, right? And we know that's unfavorable because we paid 41.50 where we were budgeting $40 an hour. It's okay. You sit there and say, well, that's unfavorable. Don't get in too big of a tissy about that. Look at your overall here, and you've got 9,700 favorable, right? The unfavorable and favorable cancel each other out. So you've got 9,700 favorable. Maybe you paid more because you used more skilled labor, and so you used fewer hours than would be budgeted for this. So again, that's where I get into this. Favorable and unfavorable is not always um, should not always be taken as pejorative on that. Okay. All right. Okay, let's flip it over now and let's do exercise 14-27. Um, and so we've got the DES company, manufactures folding chairs. Direct materials include hard plastic for the seat and back and metal beams for the legs. The standard cost sheet for a single chair includes the following direct materials information, and this is on page 612 of your book, um, right at the bottom of the page. So this is our standard on the cost sheet. Last month, DES purchased 41,500 sheets of hard plastic at a cost of 102,920. The company also purchased 82,700 metal beams at a cost of 107,510. DES produced 20,800 chairs. There was no beginning or ending inventory of plastic sheets or metal beams during the month. Okay, so when you've got one like this, you can calculate. I mean, it's still calculated at the time of purchase, the purchase price variance. But now you can compare and cross over because the amount you purchased is exactly the amount that you used, right? And so that works out very nicely in this. So last month, DES purchased 41,500 sheets of hard plastic. So we can look at our actual here. 41,500 sheets of plastic at a cost of 102,920. Now, as it turns out, we don't actually have to calculate this number here. We can get away with not calculating. You can calculate it if you want, but you don't have to. And then you put the standard over here. Um, the standard was produced 20,800 chairs. And the hard plastic is supposed to use 2 sheets. And the cost is $2.65 per sheet, or $5.30. And it should have cost us $110,240. Now we take the actual amount used here is the 41,500 and the actual cost of 265. Multiply those together. And we get 109,975. And so we compare these two. And we get $265. Remember, the one on the right is bigger, so that's favorable. And here we've got the 102,920. And we've got 7,055. Again, this is favorable. All right, again, now I didn't have to do the two middle numbers here on this materials because the amount purchased was exactly the amount used. Right, so I didn't have to do the two columns. It's when your purchase volume and your usage volume differ that you have to have the two middle columns on that. So that one. Now this one, we've got it going the same direction, so we just add those two together. And we get 7,320 favorable total materials variance. And that's for the hard plastic. Then we also do the metal beams. We're told we purchased 82,700 metal beams. And the price for that was 107,510. Okay, so we put the 82,700 times, and now we have to figure out the standard. So it's still 20,800 chairs times 4 beams this time, times $1.20 per beam. So that's $4.80 times 20,800, and we get 99,840 on that one. Now we're going to take this $1.20 here and move it right here, and we get 82,700, and we get 99,240. So going this way, we get 600 favorable. That's going to be the usage variance. We use 600 less than we expected. And here, that's the right. And then here, we used 8,270, and this will be unfavorable because the one on the right is bigger. And this time they cancel out. So we're going to get 7670 unfavorable on that one. Now, like I said, you don't have to calculate this, but if you want to, you just take the 107,510, divide it by the 82,700, and you find out you paid $1.30 when you know that the standard was to pay $1.20. We can also go ahead and do that on the one up here. 102,920. We paid $2.48 each when the standard calls for $2.65 each. All right. Hopefully that'll get you started. Don't hesitate to email me if you have any questions or need some help on some of the homework. But that should get you off to a pretty good start if you do that.